You are an entrepreneur based in Australia and thinking about starting a business. One of the first decisions you'll need to make is choosing the right business structure for you. The four most common structures are sole trader, partnership, a proprietary limited company, and trust. Some structures are easy to set up and cost effective, while others can be more costly to set up but offer better tax optimization and asset protection. There are no set rules. It all depends on where you are in your life's journey and what factors are important. Hopefully, I can help you a little today to make a more informed decision. My name is Tanvi. I'm a chartered accountant and a tax agent. And through our accounting firm, Australian Tax Specialist, I have helped hundreds of entrepreneurs set up their new businesses throughout Australia every year. Also, this is not financial advice. Every individual situation is different. If you need assistance with setting up a business, my links are below. Feel free to send me a message. Now, let's get into this. First up, we have the sole trader, the simplest and most common structure for small businesses. As a sole trader, you are the sole owner, meaning you have full control, but you are also personally responsible for all debts and liabilities in the business. Let's consider the pros for sole trader. It's easy to set up. You just have to apply for an ABN with ATO and business name with ASIC. ABN with ATO is free and business name with ASIC is $85. For example, you apply for a business name with ASIC called Josh's Carpentry. The average accountant's setup fee for these services are around $150 to $300. Now, other pros are full control over decision making and profits. You are basically your own boss. Whatever you decide pretty much goes. Third positive, it's simple tax reporting. Income goes on your personal tax return. This is very simple. What your net profit is, that is your taxable income. For example, in the first year of business, if your net profit is $75,000, you will pay approximately $14,500 in individual tax when you lodge your tax returns. Now, in terms of cons, I'll list three. These are unlimited liability. It's one of the most important ones. Your personal assets, for example, house, car, savings, are at risk. You are personally liable. For example, let's say you're a bricklayer and you get sued and your insurance does not cover the payout, then you're personally liable to pay those debts. Number two, in terms of cons, harder to raise capital. Banks may be hesitant to lend because of high personal liability. You may find banks will be more stringent to lend you money. And the reality is, without debt financing, it's hard to scale up and grow. Tax inefficiency. If you are a high income earner, you cannot income split. For example, from your sole trader business, if your net profit is $250,000, then you would pay tax at the marginal tax bracket, which would be around $72,000. If this was in a company, you would be paying flat tax rate at 25%, which is around $62,000. Furthermore, in a company structure, you could do a mix of salary or dividends and really take advantage of this entire structure. More to come on this later. Partnership. This is where two or more people or other entities run a business together. The partnership can be between two people or a company and another person or between trust. There are two types of partnerships. General partnership, where responsibility and equity is equal between partners, or limited partnership, where partners' share of the partnership is limited to the contribution or equity arrangement. For example, person A is 80% and person B is 20% owner. That's where a limited partnership is. Let's consider the pros and cons. Pros: shared responsibility and resources. This is relatively easy to set up, and most partnerships share responsibility and resources, and this is the most cost-effective way to start a business with someone. Profit and loss of the partnership are transferred out to each individual partners. For example, the net profit of your partnership business is 100,000. Each partner will receive 50,000 in partnership distribution, which is then assessable income in your individual tax return. In terms of other pros, it's very easy to set up. All you need is a partnership agreement. We advise it's good to have a partnership agreement, and it's similar to sole trader in terms of setting up. Very simple. Let's consider the cons. Joint liability. Each partner is personally liable for business debts. Potential disputes and dissolution of partnership. Number 2 in cons. Without a clear agreement, if there is disputes, and then let's face it, there will always be some sort of disputes, then partnership can be dissolved. Also, very importantly, in the death of a partner, the whole structure dissolves. Number 3 in cons. Profit sharing may lead to tax inefficiencies. This is because when you have equal share or based on equity, you cannot change the distribution that each individual partner receives. So if one partner has other income, let's say rental income, and they receive partnership distribution, they get pushed into a higher tax bracket, and effectively they're paying a higher level of tax. In my opinion, partnership is good for businesses with multiple owners who trust each other. For example, a lot of law firms are partnerships. You will typically have 4 lawyers jointly own a law firm through a partnership structure, and that structure could be a partnership between each of the individuals or their respective personal companies or trust that enter into a partnership to operate this law practice. Company. Now let's talk about a company, Pty Limited. This is a separate legal entity from its owners. This is the go-to structure for businesses that want limited liability and growth potential, and also the most popular structure for business owners in Australia. Let's look at the pros. There's 3 pros in this. Number 1, limited liability. Shareholders are not personally liable for companies' debts. A company provides limited liability. This is the single biggest positive in operating a business through a company structure. Shareholders are not liable for any form of liabilities incurred by the company. Number 2, tax benefits. 30% corporate tax rate versus personal tax rate. Tax benefits are that as a company, the tax rate is flat rate of tax, which is 25% for a small business and 30% for large and passive income earning businesses. Typically, a small business is a business with less than $50 million in aggregated annual turnover and less than 20% passive income. Number 2 in pros. Easier to raise capital. Investors prefer companies. It's easier to raise capital as a company. For example, you want to sell 2% of your company and in return, you want $20,000. This is very easy to do. The transfer of shares occurs through ASIC registry to crystallize that sale. More expensive and complex. For example, ASIC fees and annual reporting. You will need to apply with ASIC trading requirements. For example, insolvent trading is against Corporations Act, and directors have a duty of care to prevent insolvent trading. You will need to pay an annual ASIC fee as long as the company is active. This is currently $321 annually, at the time of recording, it goes up every year by $10 to $15. Record keeping. This is another important element. You will need to maintain proper accounting. Your accounting records should accurately reflect the financial performance and position. And most often, you would need to engage an accountant/tax agent to prepare your taxes. Overall thought, the pros outweigh the cons. And to be honest, these are not very difficult to manage. Finally, we have trust, a more complex but flexible structure where a trustee holds assets for beneficiaries. There are many types of trust, but the three most common types of trust for majority of entrepreneurs in Australia are discretionary trust, unit trust, and fixed trusts. Let's quickly elaborate on these three. Discretionary trust, otherwise also known as family trust. This kind of trust allow you to distribute profit of the trust to beneficiaries the way the trustee sees fit. For example, you can decide who to distribute and what amount to distribute with trust. This is the most common type of trust for business owners. Let me give you an example of how a typical business operates through a trust. Let's say you run a restaurant business through a trust and your family are involved in the operations. You can pay all employees wages as well as family members, if you like, through the trust. Then any leftover profits after expenses, depreciation and so on, you can then distribute out the remaining profit to family members or another bucket company to pay tax at their marginal rate. Unit trust. A unit trust is made up of any number of units, and there would be unit holders who own these units. Similar to discretionary trust, you would have a trustee who is responsible for managing the trust asset. Any net profit from the trust is distributed to the unit holders based on the proportion they hold. For example, if you own 20% of the units, you will receive 20% of the distribution. Unit trusts are not typically used for a trading business. Most often it is used as an investment vehicle. For example, you have four parties who wants to buy a block of land to develop and sell the houses built on that land. This is where you will have four parties come together to own that asset, that block of land, through an unit trust. Pros for unit trust, there's three of them. Let's consider them. Asset protection and tax planning. Income splitting among beneficiaries. Number two, unit holders can sell the units if they want to exit. For example, one party wants to exit, they can simply sell the number of units they hold to other unit holders or to an external party. Great for property investment. Let's consider the cons. Complex and costly to set up. You'll have to maintain accounting records, legal documents, legal fees, accounting fees. Strict compliance. Trustees have obligations. You'll have to maintain those things. You cannot retain profits. A trust cannot retain profits within the trust. It has to distribute out to beneficiaries. This is best for investors in a business or who are investors in property. Fixed trust. A fixed trust is a trust where beneficiaries have a predetermined interest in the income and capital gains of the trust. An example of a fixed trust is, let's say there's two beneficiaries. Person A will receive all the general income of the trust, which may be income from profit from business, general business, and person B will receive any capital gains from sale of shares or property held by the trust. Conclusion. Now, to sum this up and to quickly summarize all the four structures discussed, let's quickly go through this. Sole trader. If you're new to business and do not have any assets and your overall income from this venture may not be very significant, then sole trader could be a very good option to get started with. Partnership. If you are looking to get into business with someone for the short term, this is a good option and worth considering. A proprietary limited company or a PTY. This is the choice of structure for most entrepreneurs. You could use this structure for almost any businesses. Trust. Trusts are a great structure, and this will allow you to distribute income to beneficiaries of your choice. This is very good for family-run businesses or an investment vehicle. A combination of company, trust, and partnership. This is slightly more advanced level of structuring, and this is an additional level if you are interested in asset protection and potential exit strategies down the track. There is no one-stop standard solution that is for everyone. Often when we set up a business for our clients, we ask them what their plans are and goals are, and then we may recommend structure or a combination of two different structures to suit them. If you want our help in setting up a business, feel free to reach out to me. My details are on the links below. Good luck to you and your business.